All right. Well, thanks everyone for coming. I'm excited here. We have Jonathan Spitz, who is from Lightstone Direct, a real estate investing firm who is doing some awesome things, and I think has a really, really cool philosophy that they're going to share today. And in basically, what they've offered to do, and I asked them to do, is kind of share their 2026 investing playbook and where they see opportunities and how things have changed, what that means, and how you can adapt and still invest really successfully in real estate, and in this case passively, so where you don't have to be doing all of the active elements of the management like I am. So this is going to be really super informative. We want it to be interactive, so definitely questions as you have them. If you want to jump in and ask, absolutely do that, or put them in the chat. We'll make sure we have ample time for Q&A. But with that, Jonathan, I'll turn it over to you, and thanks for joining us and excited to have you here.
Yeah, thanks, Jordan, and good evening, everyone. Let me share my screen really quick. Okay. All right, can you guys see the presentation?
Yes, all good.
All right. Well, good evening, everyone. Again, my name is Jonathan Spitz. I lead the capital formation team here at Lightstone Direct. And during our time tonight, I'm going to provide just a quick overview of Lightstone and our Lightstone Direct platform. From there, I'll walk through how we're thinking about the current state of the real estate market, what we're expecting heading into next year, what opportunities we're seeing, and how we're positioning our portfolio accordingly. So I'll wrap up with some quick Q&A, but my goal today is really simple, is just to give you a clear view of where we believe we are in Lightstone is navigating this environment and where we see the most compelling opportunities for investors next year. So with that, let's just jump in. So Lightstone is one of the largest privately held real estate companies in the country. In 1986, our co-founder, David Lichtenstein, purchased a duplex in Lakewood, New Jersey, using credit card debt, back when that was something that you could actually do. And fast forward now almost 40 years, and Lightstone has really grown into a $12 billion real estate platform with a diversified portfolio of more than 25,000 apartments and 12 million square feet of industrial space across 26 states. And that diversification across different property types and different markets has been a big part of our success. It's helped us stay resilient through multiple market cycles, both the GFC and the most recent interest rate hikes starting in 2022. And it's really allowed us to be selective. I alluded to the fact that we invest in multifamily and industrial, but we also have a life sciences business. We own 5,100 hotel keys. We own retail. So we really own across a broad range of asset classes. Obviously, our apartment portfolio and our industrial strategy just happens to be the biggest of that. Now, what really sets us apart, though, is really not just where we invest, but how we invest. We put a meaningful amount of our own capital into every deal we do. So that alignment keeps us disciplined, more importantly, entrepreneurial, and allows us to stay focused on the long term. I mean, over the last over 2 decades now, this philosophy has enabled us to deliver an average realized IRR of over 27% and a 2.5 net equity multiple. So for every dollar we invest, we've been able to generate $2.5 in return across over 55 realized investments. And at the core of everything we do, we were really guided by three principles, right? We always want to be in control. We want to be aligned with our investors and do deals where we have incredibly high conviction. So we want to control everything from buying the property, how it's managed day to day. We stay aligned with our investors by putting real capital at risk alongside them. We only pursue opportunities where we have deep local knowledge and the ability to improve the assets ourselves, not just hope that the market does the work for us. So just quickly about Lightstone Direct and platform. So at its core, Lightstone Direct was really just designed to give individual investors access to the same multifamily and industrial opportunities that we pursue with our own capital. These are investments that Lightstone will make regardless of how much capital we raise through the platform. So as an example, we just acquired a multi-tenant industrial deal that we'll talk about a little bit later last week. And notice that I say like it's going to be the first deal that we offer to our investors, But a key distinction here is like we've already closed on this property. So it's just a very different way of doing business than how most managers operate, where they typically need to raise 90 to 95% of the capital before they can even close on the investment. At Lightstone, we commit 100% of our own capital, our balance sheet capital upfront, which gives us the ability to act quickly, secure attractive opportunities, and bring investors into deals where we have incredibly high conviction. So the second principle or the second part of that, which I already touched on, is just being really aligned. So what this bar chart on the right is showing is, we put at least, so while we close oftentimes 100% of the equity up front, even once investors come into our deals, we always will maintain at least 20% of the equity in the deal. So most managers, maybe they put 1, 2, 3, 5% in every deal. We put 20% in every deal, which is just a different level of alignment. And obviously the last part is the experience, which I talked about earlier. Just obviously we've been around since 1986 and amassed a $12 billion portfolio. So before getting into what we expect next year, let's start by talking about where the market's been and where we are today. So the image on this slide actually came from an old real estate textbook that was created in 1995. But what's really interesting is that as we talk about the most recent market cycle experienced over the last decade, it looks very much like this chart, right? And this chart was made 30 years ago, right? Longer. Real estate continues to move through these cycles, this recovery, the expansion, hyper supply, and recessionary phases, just at different speeds, just depending on what property type and what region. So let's go back in time for a minute. So from around 2012 through 2022, we experienced one of the longest and most powerful expansion cycles in modern real estate history. Interest rates were low, capital was cheap, and for a long stretch, new development really lagged demand. So whether you were buying multifamily and industrial, retail, maybe not retail for a lot of that, but the wind was really at your back. But by late 2020 and late in 2021, signs of overheating started to emerge. Occupancy became really tight. I think we all know where we were during this period in time. Rents were growing by 10, 15% a year. Valuations hit record high. Development pipelines hit multi-decade highs, especially in Class A multifamily and industrial projects. And so this was just classic, like late cycle behavior, right? In hindsight, of course, but at the time, Lightstone, we were very familiar with this, right? We've seen this before, and where property pricing was reaching unrealistic levels, competition for deals was intensifying, and investors were convincing themselves that growth would continue indefinitely. So at Lightstone, we actually became like pretty much net sellers at this point, right? We became liquidating, or we started to liquidate a large portion of our industrial portfolio, and in most cases, we were doubling our money in inside of 24 months. And it's not to say look, we were glad that we had those exits, but like that's just how frothy the market got, is that you could just turn around and flip properties that and just make, crazy returns. It was just very abnormal time in the market. And this was the beginning of that hyper supply phase that you see up here on the screen. And the recession, which lasted really from 2022 through the first half of 2025. And during this period, we saw a record amount of new Class A multifamily and industrial supply hit the market. So years of cheap financing and an elevated construction pipeline that I talked about from 2021 collided with a higher interest rate environment in 2022 to 2024, flooding the market with a bunch of new inventory just as demand began to moderate. So that imbalance that we've seen over the last 3 years has really put pressure on rent growth, occupancies, especially at the top end of the market, that Class A multifamily and industrial, predominantly in the Sun Belt region where a lot of that development was happening. But look, it's really important to recognize here that while the market has experienced real disruption, this has not been a repeat of the great financial crisis. What we've seen, we haven't seen a systemic leverage problem, widespread defaults, or demand collapse because of job losses. What we have seen are certain managers, often those who took on too much leverage or underwrote aggressive rent growth assumptions, struggle as that cost of capital reset. But that's really been the exception, not the rule. So where are we today? So the past few years, again, have been a challenging place to real estate has been a very challenging place to invest. As interest rates started rising in 2022, property values gradually started to come down, but not everyone agreed on, what things were really worth, right? Rising borrowing costs have challenged how buyers underwrite deals, while many sellers were still anchored to valuations from that COVID era bubble time period. But now coming 3 years into this, we really believe that the market is starting to turn a corner. Right? As of today, multifamily and industrial valuations are down roughly 20 to 30% from their 2023 peak. And this is really creating one of the more compelling entry points that we've seen. While higher interest rates have certainly created plenty of headwinds, one benefit of higher interest rates is that it's brought new development activity to a screeching halt. We've already seen a 60% decline in new industrial completions and a 32% drop in multifamily completions. So that slowdown is critical if you think about wanting to invest in an asset class, because it just means that your future competition in the property that you're investing in is dissipating, right? There's going to be less new supply, less competition coming online in subsequent years. And so over the next few years, we believe that this limited supply pipeline rather is going to stabilize occupancy, support rent growth, and create a stronger foundation for long-term capital appreciation as we begin this recovery phase of the real estate cycle that I showed you on the previous screen. So now that we've talked about where the market's been, where we sit today, let's shift gears a bit and let's talk about how we're thinking about asset allocation over the next 12 months and where we're really going to be spending our money. So every decision at Lightstone begins with a very top-down perspective, right? When we evaluate any asset class, the first question, what's driving demand over the next decade, not the next quarter, right? What's driving demand over the next decade, not the next quarter? We want to make sure we're positioned in sectors with long-term structural tailwinds, not short-term momentum. And there's a big difference, right? Second, we're supply constrained markets, places where development has been limited, which supports rent growth and stable occupancy. So, as just a quick example of that, our multifamily portfolio we'll talk about in a little bit. We've been focused more on the Midwest as opposed to the Sun Belt because there's just been less supply. Third, we want to be buying below replacement cost. That means we're acquiring quality assets for less than it would cost if you tried to build them today. So that's a built-in margin of safety that limits our downside risk. Fourth, we're prioritizing strong in-place cash flow. So in this environment specifically, I mean, in really all markets, candidly, but cash flow matters more than ever. And we're focused on deals that generate durable income from day one with upside potential through marking rents to market over time. We'll talk more about that through a few examples in a bit. And finally, we're focused on creating value through active management. So Lightstone, we are a hands-on owner operator. We don't rely on the market to make our returns. We create them through operational improvements, leasing strategies, and capital improvement plans. So in short, our playbook for this year, for next year, is really still about being selective, being disciplined, and focus on the fundamentals that I mentioned above, targeting opportunities where we can compound capital over time. So for those on the call who are thinking about their own portfolios, so if you're thinking about your own asset allocation strategy, this approach really comes down to risk and timing. We're entering a period where not every sector or every market will perform the same. They're all at different stages of that market cycle that I showed you earlier. And that's why being selective matters. By focusing on assets with strong long-term demand drivers, limited new supply, and healthy in-place cash flow, we're positioning capital in areas that can deliver steady income while still offering upside as the market begins to normalize, as we're in the early innings of that recovery phase. So now let's take that framework and apply it to where we see the most attractive opportunities kind of within this framework, right? So across really the industrial multifamily landscapes, there are really multiple subsectors we analyze to identify where the most attractive opportunities exist. So on the multifamily side, we've owned and operated everything from brand new Class A, newly developed assets to Class B to Class C workforce housing communities. And industrial, our experience covers, large, Class A single tenant distribution centers to smaller multi-tenant industrial parks to light manufacturing facilities and everything in between. But in today's market, we believe the most compelling opportunities lie within two segments: the workforce housing category of the multifamily sector and the shallow base segment of the industrial market. And within these categories, we focus specifically on Class B assets, which really just refers to, if you're not familiar with when I say Class B or Class A, what that means is just well located, functional properties, keyword functional, that are a bit older, usually built in the 1980s, maybe the early 2000s, and typically sit a step below your more Class A newer assets in terms of amenities and finishes. So let's just define these categories. Sorry. Shallow bay industrial real estate refers to smaller multi-tenant industrial buildings with suites that typically range 10,000 to 125,000 square feet. And these buildings cater to a diverse local and regional tenants rather than companies like Amazon, as an example. What makes shallow bay industrial so compelling is really stability. So these are buildings that have, again, 5 to 20 smaller tenants, which means that our income stream is just more naturally diversified. And on top of that, renewal rates across this segment are among the highest in the industry, with roughly 70 to 80% of tenants renewing at expiration because their businesses depend on being close to their customers. And since only about 13% of new industrial development over the past several years has been in this size range, supply remains tight despite all of the, like, again, broader industrial supply that's hit the market. And so that's helped rents continue to grow even as we've seen softening across just, all industrial. Now, workforce housing refers to affordable market rate rental housing built for middle income earners. So people who make too much to qualify for government subsidized housing, but often can't afford the higher rents of Class A apartments or the ability to purchase a home. So this group is commonly referred to as what we would say call a renter by necessity demographic. And it's really the foundation of the country's rental market. So roughly two-thirds of all renters in the United States fall into this category. Yet new construction really continues to just almost solely focus on Class A apartments because it's just simply too expensive to build at lower rent levels. And that's created really the nationwide shortfall of more than 4 million affordable units. So even during economic periods, demand for workforce housing tends to stay pretty stable. So just to dive a little bit deeper on why Class B from an investment standpoint as we look ahead into 2026. So the segment stands out for a few reasons, which I'll just touch on quickly. Again, just alluded to it. There is no new Class B supply coming, right? So that's you. Scarcity is where you want to be generally. Second, these properties often have room for improvement. So as I alluded to earlier, or at Lightstone, um, we want to be acquiring properties where we can mark rents to market, or we can upgrade properties. And again, because we very much believe in taking deals where we can add value. Finally, Class B properties tend to generate stronger cash flow than or better cash flow than newer Class A properties. These trade at higher cap rates, so investors are effectively paid more for taking on, manageable improvements. So the big picture is this. So Class B real estate serves the broader middle market economy, which is what we're focusing on. So the everyday renter, the everyday or the local business where demand is steady and supply is shrinking. So that's where we see the best combination of stability, income, and long-term upside. So now let's just dive in a bit deeper into why we like shallow bay specifically and what our investment strategy looks like. So back to our framework, right? We start with a question: what's driving demand over the next decade? Even though e-commerce is no longer a new story, it continues to be one of the biggest tailwinds. driving the industrial real estate market, and that's not slowing down anytime soon. So just think about it. Every time you order something online, whether it's a pair of shoes from Nike, groceries from Amazon Fresh, or pet food from Chewy, that product doesn't just appear at your door. It's moving through a massive network of distribution centers, warehouses, last mile delivery hubs. And the reality is, e-commerce actually needs a lot more space than traditional retail. For every dollar of online sales, companies need only, or need roughly 3 times the amount of warehouse space they need for in-store sales. And that's because those products have to be stored, packed, and shipped directly to customers with often same day or next day delivery expectations. So you might be thinking though, well, hasn't e-commerce already matured? Like, hasn't this theme already played out? And you'd be right. It's not growing at a 30% a year clip like we saw 4 or 5 years ago. But the point here is it doesn't have to. Even steady single digit growth on today's massive base creates huge incremental demand for logistics space. Now, most people think of e-commerce and picture, as I did before I got into the space, picture these huge, brand new Amazon fulfillment centers that are 1 million square feet, and you have robots zipping around. And yes, those Class A properties are a critical part of the distribution network, but that's really just half the story. The other half of the story is not as glamorous, and that's where Class B industrial really comes into play. As the big distribution networks get built out, the next battle is about proximity and speed. So consumers want everything faster, right? We just alluded to that. Next day, same day delivery results. That means companies need smaller infill facilities closer to customers to handle last mile fulfillment. And those facilities often aren't in brand new industrial parks. They're existing Class B buildings in established submarkets. These properties are the connective tissue of e-commerce logistics. They're where goods move from the regional fulfillment center to local delivery routes. They're used by parcel carriers, third-party logistics firms, and they need just 50,000 square feet to 200,000 square feet and near major highways and thoroughfares. So now again, back to the question, what's driving demand over the next decade? So reshoring has become one of the most powerful long-term catalysts for industrial real estate. So for those unfamiliar with what reshoring is, it simply just means bringing manufacturing production back to the United States. And this was a movement that really gained momentum after major supply chain disruptions during COVID. But since then, U.S. manufacturers in a wide range of industries have announced trillions, with a T, trillions, of dollars in new domestic investment. In fact, just this year alone, over 1.2 trillion in U.S. manufacturing investments have been announced. And what makes this so powerful industrial real estate specifically is that multiplier effect. So when a new manufacturing plant opens, these typically are not facilities that you can invest in. So oftentimes they're owned by the company themselves, or maybe they're owned by a much larger publicly traded REIT. Um, but when these manufacturing plants open, it doesn't just create demand for one building. It sets off a ripple effect across the entire local economy as suppliers, logistics companies, and service providers all need to be nearby. And they often require functional industrial space for storage, assembly, and distribution. So that really bolsters demand, occupancy, and rent growth for shallow bay assets that we focus on. And at Lightstone, we focus on buying in markets where this activity is already underway, where major anchors are committed and supplier demand is building. In 2024, over 244,000 reshoring jobs were announced, and Lightstone owns assets in 9 of the top 10 markets. Those jobs were being created. In a little bit, if you can try to take a picture of this map, I'll show you a different map in a little bit of our assets, and you'll see it almost overlays perfectly with where these reshoring jobs are being announced. Now let's go back to the 2026 playbook and talk about supply, right? Supply constrained markets. Why does that matter? And what's interesting here is that, again, most of the new development over the past several years has been concentrated in larger single and multi-tenant facilities. There's been very little new construction in the shallow bay and small bay segments, which is exactly where we're seeing some of the strongest rent growth and occupancy today. So it's nothing new, right? If the you have less supply, that generally is going to boost your ability uh, grow rents. And at the end of Q2, vacancy rates across buildings greater than 140,000 feet was actually 64% higher than buildings under 140,000 feet, right? So it just tells you that there's that demand is there, but that supply is not really kept up. And that's what this is showing you on the screen. So of the nearly 550 million square feet of new buildings delivered since 2018, only about 13% are buildings we would consider small bay or shallow bay assets. And so if you're seeking 20,000 to 140,000 square feet, you have very limited options. And we've actually seen this across our own portfolio. So despite softening fundamentals, um, rent growth has been strong. So as an example, earlier this year, we acquired a shallow bay property in Austin, Texas, out by the airport. And Austin is a market that if you looked it up, you'd see that there's been a lot of vacancy in and around Austin, but especially for spaces that are over 500,000 square feet. But our property tells an entirely different story. It's a multi-tenant shallow bay park with more than 20 tenants, and the average suite size is around 20,000 square feet. The majority of our tenants serve the local economy. So think contractors, suppliers, regional distributors, and that demand has stayed extremely strong. And because of that, we've maintained near full occupancy and have been able to push rents above our original projections. So it's just the perfect example of why focusing on the right size segment within the right markets can deliver consistent performance, even when the headline numbers and the broader sector look mixed. So again, when people talk about reshoring or e-commerce, again, anyways, I think of the EV plants, the large billion-dollar EV plants, or the semiconductor fads. It's TSMC, it's Samsung, it's these larger facilities. But rather than focus on the shiny newer assets, we just take a different approach by buying that functional, well-located industrial space that sits at the backbone of the supply chain. We focus on properties that are universally functional and can serve a wide range of users. They work just as well for a BMW supplier as they do for a regional distributor, a third-party logistics company, or an e-commerce tenant. We want assets that are really riding multiple tailwinds at the same time, reshoring and e-commerce, local consumption, etc. We also place a strong emphasis on established infill industrial markets that are close to population centers, major highways, and infrastructure. These are areas that tend to have a limited supply of available land and high barriers to entry into new development, which creates that consistent tenant demand for businesses that need to be near their customers. And our strategy also focuses on what we call clustering, which simply just means owning multiple properties within the same market. So by doing so, you're able to be more efficient and cost effective. So we've actually executed this strategy already in Harrisburg, Pennsylvania. That's where we currently own about 2.7 million square feet across 9 properties, and that allows us to streamline operations and share resources across the portfolio, which ultimately enhances returns. So we kind of put all that together. So whether it's reshoring, e-commerce growth, and the need for functional mid-sized logistics space near population centers, it really just kind of that defines where Lightstone is spending our time today. And so one example of how we're executing this strategy in real time is our most recent acquisition of Abernathy Industrial Park in Greenville, Spartanburg, South Carolina. So this region has become one of the most dynamic logistics corridors in the Southeast, anchored by BMW's largest global manufacturing plant and a growing network of suppliers tied to that reshoring and advanced manufacturing movement. So Abernathy fits squarely within this thesis. It's 6 building, multi-tenant logistics park located in at the intersection of I-85 and I-26. So that puts about 31% of the US population within a single day's drive. So that type of stat is really important for industrial specifically and regional distribution. And so what's really unique about this property is that, again, a previous owner put $9 million into it. upgraded the property, so now it functions like a Class A property, but we still acquired it at a 39% discount to replacement cost again. So really the point in me showing you this is if you go back to what our 2026 playbook was and how we defined it, kind of this property checks all those boxes, right? We're buying it at a 39% discount to replacement cost to give us that downside protection, right? It's got strong in-place cash flow. We're averaging almost an 8% annual cash on cash returns. Um, and again, it is occupied by tenants that are, the backbone of the supply chain, which is what we typically look for. So we actually just closed on this project last week. It'll actually be the first property that's available on our Lightstone Direct platform. This just gives you a quick snapshot of our performance. Again, if you remember the map from earlier of where all those announcements, those reshoring announcements were made, you look at our portfolio, pretty much overlap with each other, right? Um, and what you can see here is that what's really interesting, um, is that as of Q3, our asset management team, we've signed 23 leases totaling almost 1.2 million square feet of industrial space. So most of these are shallow bay industrial real estate for the most part, shallow bay, small bay. And we're executing leases right now that are 20% above pro forma. And these were rents that were signed with 0 months of concessions. And if you don't know what concessions is, generally it just means free rent, right? It's to incentivize a tenant because demand is so strong, we don't need to, right? So that's, again, we're seeing that kind of demand across our portfolio, which gives us conviction to continue making investments across the sector. So kind of turning the page over to workforce housing. So as I'm sure most people on this call know, housing affordability remains one of the most pressing issues facing the U.S. economy. So higher mortgage rates and stubbornly high home prices are forcing more Americans to rent for longer. So if you look at this chart on this slide, what you see here is what the black line is showing you is what is the average cost to own a home, right? But when you factor in mortgage payment, insurance, taxes, and it's comparing that to the gray line, which is the average effective rent for a multifamily apartment unit in the country. What this is showing you is that on average, owning a home is $1,210 a month more expensive than it is to rent. That's almost three times long-term average. The long-term average is $432 a month. It's usually more expensive to own a home than it is to rent. That's pretty pronounced, right? It's become so pronounced that even just a modest drop in interest rates or home prices is not going to really make a meaningful difference in the cost gap. So to be closer to that long-term average, home prices need to decline over 12% or interest rates need to go back to around 3.5%. And this trend is really compounded by generational shifts in housing preferences, right? So you have many young renters view renting as a smarter financial decision than owning. And in fact, RealPage, which is a data analytics firm, they did a renter study in 2024, and they said nearly 75% of renters said they lived in areas they could not afford to buy. And 51% of the Gen Z renters surveyed believe that they just viewed renting was a smarter financial decision than owning, right? So that dynamic, that combination of preferences and limited housing affordability just continues to fuel um, strong demand, even though there has been a lot of supply, which I talked about in another slide. And that's really playing out right here on, as you can see. So, as I alluded to earlier, like the market has been absorbing a 40-year high in apartment supply, 40-year high, with over 70% of that supply being delivered in the Sun Belt. But despite the heightened supply, annual rental demand reached an all-time high at the end of Q2, surpassing the previous record that was set during COVID. So, but in high supply markets, so your Austin, Texas, your Phoenix, Arizona, Nashville, Tennessee, or Atlanta, landlords have had to offer deep move-in incentives of 3 months of rent and deep rent discounts just to remain competitive and keep their buildings occupied. This has put downward pressure on rent growth over the last several years, but by contrast, the Midwest has not been hit with that same amount of supply, and this has been a quiet outperformer over the last couple of years. Um, but that new apartment supply across the country has already fallen 32% from its peak in and that really happened at the end of 24. And it's projected to fall another 25% over the next 12 months. So this is really setting up a favorable backdrop for rent growth and a rebound in property valuations moving forward. But despite this favorable backdrop, our multifamily investment strategy remains highly selective and disciplined. We're seeing more opportunities today than we've seen in years, but we're being careful to focus only on ones that truly align with our investment criteria. We focus mostly on tier two cities with strong employment drivers and healthy supply and demand dynamics. So both of these are critical in our investment decision framework. So as an example, the Sun Belt has been a hot spot for investors over the last few years, and for good reason, right? Population growth there surged during and after COVID, and that really resulted in a euphoric rise in rent growth. And that drove a flood of that development activity that we've been talking about into the region. Yet, even with a record amount of supply being delivered into the market, many assets in this region remain priced as if rents are going to keep rising at the same breakneck pace they did during COVID when demand spiked and rents were growing 10 to 20% a year. But that kind of growth just like simply isn't sustainable, especially during periods of elevated supply. So like that's why we just aren't on the Sun Belt. Like we love the story. Deals there are just not making sense. But while we've been selectively allocating there, right, over the last couple of years, we did a deal in just outside of Melbourne on the Space Coast. Our primary focus has been in the Midwest, where both fundamentals and valuations present a better relative value opportunity. So in 2018 through 2021, Lightstone made significant investments in Michigan, Columbus, and Detroit, which in all three of these markets have led the country in rent growth over the last 2 years. But 5 or 6 years ago, no one wanted to invest in these cities as everyone was still chasing deals in the Southeast. So I guess the main takeaway here for people on the call is avoid chasing yesterday's headlines, right? The Sun Belt story what has been powerful for much of the past decade. We believe those markets will continue to perform well over the long term. That being said, the price you pay matters. It is just as important as location, right? You'll hear location, location, location. Obviously, that's the most important rule in real estate, but the price you pay matters. And striking that balance is key to generating strong risk-adjusted returns over the long term. And this just gives you an example of how that's translated into performance, right? Again, investing in supply constrained markets, focusing on cash flow. And so I know this chart may look a little confusing, but I'll try to simplify it. The black bars in this chart represent the average year-over-year rent growth over the last 12 months across three Midwest markets, the three Sun Belt markets, and then the US average. And you can see how significant the outperformance has been across the Midwest and Lightstone's portfolio assets, right? Again, this just goes back to the decisions we made to focus on those Midwest markets when it wasn't the popular thing to do. So that's all the time I have. If you'd like to continue the conversation or if you have any questions about anything we discussed today, whether it's related to just the broader real estate market or portfolio construction or our approach at Lightstone, feel free to reach out. I've included contact information here for our team along with our QR code that links to our landing page. If you're interested in staying connected with us, we'll be releasing some cool education and white papers here in the near future. So that wraps up my presentation. Thank you all for your time and attention. Jordan, I'll turn it back over to you.
Awesome. No, thank you, Jonathan. That was such a great run through of so many different things. And I think what continues to impress me the most with you guys in Lightstone is just a laser focus on like strategy and creating a thesis and plan for investing successfully and sticking to it, which sounds very easy. It sounds very easy to say, this is how we invest. These are our parameters. These are the numbers we look for. These are our defining, variables. But when you're pressed or looking at deals or maybe deals are coming slower than you anticipate or whatever it is, it's easy to kind of expand them in the moment and go, well, we can probably get away with this or we could get away with that. And to just have that criteria and do it, I think that's that's what makes a successful investor. And, with real estate, with anything, there's a bunch of different ways that you can do it and can do it successfully, but you have to really define what's your strategy. And I think stick with it within the context of, adapting to the market, but always being true to what your core values are that drive your investment. So I commend you guys on that. And I think seeing it in the residential and the commercial space and how you guys are integrating that is super impressive. So that was definitely, a master class. Definitely, I see we have some questions coming in. Definitely put them in. If you want to ask them live, just put up your virtual hand and we can have you ask. Martin is leading it off. Is this or do you guys have investments that are 1031 eligible? And then I'll address the question to me as well. So
Yeah.
1031 eligibility.
Yeah, so no, the answer is a common question. No, our deals are not 1031 eligible at this time.
Okay. And
So
then
you have to there's some limitations for whatever it's worth. If someone's exploring that space right now and looking to do 1031 passively, so you have to structure an investment as what's called a Delaware Statutory Trust or a DST. You'll commonly refer to that. And especially because there are some limitations as far as what we can do strategically once an investment is structured like that. So we don't we're not doing that at this point.
okay. Um, okay. I'm gonna ask his follow-up question first, and then I'll answer the question directed to me. What's the minimum investment, or does it vary per opportunity?
Yeah, so it's generally 100,000. Obviously, we'll work with people, again, if that want to, but like generally 100,000. Like I
Okay.
said, we'll take it.
Okay. Um, and then the question directed to me, wondering why my wife and I invest actively in rentals. Why do we do that versus investing passively? Investing passively is something that we at some point we will do. The main reason we invest actively at this point is with my wife qualifying, you know, pretty much every year for real estate professional statuses, we get a huge tax benefit with that. But it does come with a lot of time spent and headaches and things like that. So it's certainly, I would say, of the people I talk to in the physician space, probably like 80% or more are more interested in passive investments. Again, you can build wealth that way very, very well, obviously. The key is, you're giving your money to someone else to invest. And so you have to make sure you're working with someone like Jonathan or someone who is doing it the right way. And I think like you alluded to, there was a time period during COVID when rates were low and everything like that. And a lot of operators were using adjustable rate mortgages and things like that and really got into a lot of trouble because then when rates went up from their historic lows, which, was a reasonable prediction, the people who were, who weren't set up right, um, they got hit and their investors got capital calls or lost capital and things like that. So that's why working with someone where you really understand their investment philosophy, and can look at their track record is super important. Before we get to the next
100%.
question,
And I was
Jonathan,
gonna say, I want to actually just add to that.
yes, please.
So I couldn't agree more, honestly, with what Jordan just said. Like the biggest part of due diligence, if you've never invested passively before, you want to be paying more attention or ask more questions about the manager. I mean, j just as many questions about the individual asset, right? Because when you make an investment with us, it's a 4 or 5 year investment, right? And so it's a long-term partnership. So, like I said, I couldn't agree more. And I said I've been working with investors for 6 years and a lot of doctors. And whether you're choosing to, if you're looking at investing passively for the first time, like I'm happy to help you. Just like what questions should some people just don't know what questions to ask, which I get. It's a lot. I'm always happy to help in that regard. If anyone wants to shoot me an email, like I said, I'm happy to help give you some questions, whether you're talking to another manager or us, anything like that.
What would you say, and Emilio, we're getting to your question, I promise. Just on this is such a great line of conversation. What for you? is like if someone's talking to an operator, what are, I don't know, give me two or three big red flags that you see.
Yeah, so one is usually, have they done this investment strategy before in that market, right? So, and how much leverage do they have? How long have they been around? How much money do they have in the deal?
Hmm.
Like usually like that's kind of where you want to start. Like what gets most operators into trouble is leverage, right? Taking on 80, 70, 80, 90% debt. So like people will I remember people used to send me decks all the time and they'd say they're showing a 25% IRR or a 10% distribution yield. And you look and you're like, well, that's because they're levered it and for that they're putting so much debt on the property to juice those returns. The problem with debt, too much debt, is it magnifies returns in both directions. So if things go well, yes, you can make a lot of money, but if things even go remotely wrong, you can get wiped out. And so, like, understanding how much debt someone has and how much money they have of their own money invested. So if you go back to the beginning of the presentation, why we emphasize, look, we're putting 20% of our own money in the deal because it's very uncommon in the industry to see that. Typically, it's 1 or 2%. But then even you'll see the most experienced managers, if they go into a new market and they've never invested in that market before, or they don't have like that is another thing that can get people into trouble. Like as an example, we own in South Carolina already, right? And if we go into a new market, there's a huge process that goes into that. If we just went into Louisville as an example, and that required a ton of due diligence and approvals for us to do that. Right. So like, and again, like we're generally like, we don't like when we move into Louisville, we're going to do that with our money first. We're not going to, we're like, we don't want our investors to come along for that ride necessarily. So I think those are a good starting point to understand. And again, how long have they been around? I think what we've seen a lot recently is so many managers sprung up after the great financial crisis, and they've never experienced what a down market looks like until now. And so you're seeing a lot of managers really get into trouble because they've never had to navigate volatility before. But again, that's with us. We've been around since 1986. I mean, and look, we had our own problems in 2007. We learned from those and grew and built a much more durable company coming out of that. So yeah, long-winded way to answer your question.
No,
Sorry,
but
but
that's great information. And I think I will say as well, definitely the 20% investment is the highest I've seen. And I think that's awesome because again, you
mm,
want the sayings no one's gonna care about your money as much as you will, but if they're putting their money in with it, then they're gonna care about it too. So that's
100%.
definitely an important thing. Um,
100%.
Okay, Emilio, get into your questions, which are fantastic. Uh, Typical investment amount, we said around 100,000, but they'll work with you. How do you get your money out and over what period of time? So talking about distributions and again, distributions during the 5-year period. So how is that typically structured for you guys?
Yeah, so I mean, so every deal is obviously different, but generally we're looking at deals that are between 3 and 5 years. As an example of the Abernathy industrial deal that we just launched, that's a 4-year deal. We're targeting a 15% net IRR with this average distributions of over 7.5% during the holding period. So monthly distributions that start day one. So I think our starting yield is over 6%. And as part of our business plan there is to mark leases to market. So we have an industrial rent roll. Their leases are expiring in 3 years. We'll raise those rents to market, and that will actually increase the cash flow distributions that we can deliver to investors. So you're earning monthly dividends over a course of 4 years, and then we will sell that investment at the end of 4 years after we've executed our value add business plan. And then that's when you get all of your money back. And obviously, the goal is to deliver a return as well, in addition to the cash flow distributions that you're earning over the life of the investment.
Fantastic. Certainly any other questions, please throw them in. Um, One question I had, so you talk about the importance in your strategy of finding these Class B properties and buying below replacement cost. Is that, I will hear some investors say that that's a challenge or that's not, really something that can be done anymore. Obviously those are, tend to be excuses or things like that. There's always deals as you can find them. How are you guys sourcing these deals and finding them? doing due diligence on it. Can you kind of run through that process a little bit?
Yeah, I mean, well, when it comes to Class B assets, I mean, they're generally going to trade at some type of discount to replacement cost just because of the vintage. I think generally what we see that where the biggest mistake people make when it comes to buying these types of assets is one, making the distinction between Class B and Class C, right? And understanding like what the actual the business plan, like what is going to be the cost to bring that asset back up to to its optimal level. I
Hmm.
think that's mostly what we see when people try to execute a value add strategy, whether it's Class B or Class C, is massively understating what the true cost is to do that. Now, what's unique about, again, Lightstone is that we really have some proprietary insights in that we have a 15, 12 million square feet of industrial to look at and understand how much is going to cost to replace the roof, right?
Hmm.
You know, what's important to our tenants right now as far as if they leave, what capital expenditures are going to be required. So like the deals are out there, but I think it starts with just having a national footprint. So we own assets in 26 states. Look, it's hard. It's very, very hard to find deals. It's very hard to find good quality deals that we actually close on. So
Hmm.
as an example, last year we did 3 deals, you know. And I mean, I sit in investment committee every single week and on Tuesdays, and we look at 6 to 10 deals every week. And it got to go through our internal ringer, right? So, we look at a lot of activity. Very few actually make it across the finish line, but it comes from having boots on the ground in markets, having relationships with brokers that know we can close and know we can execute. That's a lot of it is, when oftentimes because of our size and how long we've been around, if we're sitting at a table and let's say we are bidding against other people, oftentimes, especially in this market because of the way the financing world looks like, um, a seller wants to know that you're going to be able to actually close. And
Hmm.
so we will go non-refundable deposits quickly. We'll put up, large earnest money deposits. Like and we'll do things that again really strengthen our hand at the table. So it's really a combination of just, it's a numbers game too, right? Like if we're going to close on 2 deals, you're going to have to look at 100 to get there.
Hmm.
So I think that's the numbers game that frankly I think a lot of people don't understand is, you start looking at deals and it's also very tough if you're limited to one market. There are benefits to being an expert in your market for sure. But like again, we can cast a much wider net with, we have a 40-person investment team and boots on the ground. So it's really just a long-winded way of answering your question, but
Awesome. No, super, super helpful. Um, all right, last question here. And certainly you guys have information. We'll send out a replay. And so if there are more questions for Jonathan, definitely I encourage you to reach out. Is there a target goal of appreciation upon selling in 3 to 5 years um, that you guys have typically?
every deal is different. So I wouldn't say it just always depends on the deal. So in this specific deal, yes, we are there we are targeting appreciation. So this is a very unique deal where we have, you're earning, strong, healthy, tax efficient cash flow immediately day one, and there's some upside on the deal as well. So yeah, it's about, 15 to 20% of value that we're creating. Um, I wouldn't say that's always the target because some deals are different. So that's what's really unique about what we do at Lightstone is that, we have, whether it's shallow bay or whether we're doing multifamily, they can fit different investment profiles. Some what we would call coupon clippers. Something might just be, long-term leases to credit tenants where you're just earning 9, 10% returns, but there's really no upside, right?
Yeah,
So it's a different investment profile. So it just really very much depends on the deal.
makes a lot of sense. Last question I'll fit in of this. How many employees does Lightstone have? How many principals?
Yeah, so we have over 600 employees across the country, and so our founder David Lichtenstein still again founded the company in 1986. He is still the founder and CEO, and our principal and president Mitch Hochberg, who is really the operating partner of the company. So it's really those two.
Awesome. Well, thank you so much. This was incredibly informative. I know I definitely learned a ton. I encourage anyone watching now or watching a replay, you guys have the contact information. Please reach out. Jonathan, thank you so much for your time. Everyone joining, thank you so much for your time and have
Yeah.
a great night.
Thank you. Take care, everyone. Thanks, Jordan.
Bye, guys.